Yeah, I'm losing my
And
edge.
with the stock market, another new high in equities. And today I wanted to show you how to sell equities, which I think is a novel idea that no one has thought of. No, I think it's unfortunately an idea that many people have struggled with in recent trade, given S&Ps, NASDAQ, Dow, and our SM75 here especially blowing out all-time highs, Pete. Started the year with some back and forth. You can see here a couple notches,
Right.
a little bit of back and forth. Are they going to come off of these highs from 2020? Are they going to expand on them? And then it's just like a 10% run here in SM75 in the first 2 weeks of trade here. And it's gotten to the point where I hope a lot of people, you and I have tried to do a lot of work on this in the last couple of years. And I think a lot of people through their own experiences have come to this conclusion, Pete, that you can't just sell an all-time high, right? Like you can't get to the E-mini S&P or the NASDAQ futures and just go short every all-time high, right?
No, that is, as we've seen over the last month, year, and going back past that is not a long-term successful strategy. We talk about this endlessly. Even this market, these moves are so dramatic. It's actually hard. The best thing I can take away from this is a short bias with the appropriate mechanics and discipline management mitigated your loss. It didn't take the loss away, but it mitigated it. If you had a little bit longer term bias, because this kind of upside is really relentless. So you're absolutely right. We continue to move up. And part of what I like to think about too is, Frank, we talk about being able to trade both sides of the market. We are not guys who buy a breakout at contract highs, but
Sure.
The ability to trade a little, not look for the next trade has to be 50, because that was the middle of the market. Looking for reasonable expectations here is really important. Here, I mean, for me, the takeaway is I've got other products on. My 10s are working. My dollar index is working. This is why we diversify across the currencies. This may not be the one that is if you're being a contrarian, but the management around it is so important.
Yeah, absolutely. Whether it's management, we have a lot of great content on managing futures trades specifically. Definitely check that stuff out. Because, yeah, it's a matter of with management, before even getting into our couple of ways to try to sell stocks and adding time, which is going to be the theme of today's show, adding some mechanics in management first also keeps a 10% up move here that you sold into, as opposed to all 10 percentage points going against you. Maybe you take 2% in losses and then you wait to put that back on, another 2%. Management and taking losses and all this work we've done on that is working towards exactly what you're talking about. Because, yeah, Pete, the people who sold in the first week of the year here in 2021 and just said, I'm holding out for 55 or 50, or in S&Ps, I'm holding out for 3,600. It's like, man, you're going to take a lot of pain on the way to that, because what we've seen is you need time. Like, look at all of these all-time highs here, and then you get a little bit of it from 2019 and the years prior where they cluster, right? Like there's big down moves, and everybody wants to be the person who sold that all-time high and took it through the stock market crash. That's one trade per year usually. And so, and Pete, correct me if I'm wrong, but no one ever sells the high print in any market. There's quite literally going to be a couple dozen people in the world who get the high print in any futures market. So that's not a sustainable strategy. And
Absolutely.
Since these new highs cluster, Pete, the thing you need most is time.
Right. Yes. And that's, around new highs, you've done a lot of great research around. We really rarely get a high and then a material correction. When we're at new contract highs or a new trading level, it takes time for that turnaround to unfold. So you're absolutely right. We need time to help us with location.
Yeah, absolutely. And so our 3 ways to sell stocks are going to incorporate that need for time. And it's the simplest thing, Pete. The first step here is choosing your product wisely. And a lot of people go to futures because selling stocks, shares of stocks can be expensive, or some stocks that are, hard to borrow and everything else can be nearly impossible
Right.
there. So the first step is when you're coming to futures to get that efficient margining and to be able to get on the short side as easily as you get on the long side, all those advantages, make sure you're choosing a product that has the right size, and reducing size is, to me, the simplest and first step into adding time. I mean, S&P 500 futures are great for so many different things. We trade them almost every day, whether it's the options on them, the micros, or what have you, not trying to shade that market. It's a benchmark that's been around for 100 years, that's very popular, but that's a product that's over $200,000.
Right.
And so every percentage point move higher, Pete, that thing is going $2,000 against you. That's ridiculous. Like for most retail traders, taking this first 2 weeks of trade being short, $2,000 per percentage. I mean, you're probably out at least 10 grand there, as opposed to SM75, equally large move there, same stocks and same type of upside that we've seen, same all-time highs. But that SM75, Pete, is less than a 30th the size of the S&P futures, and what was more than a 10 grand loss is less than $1,000 in SM75 this year.
Absolutely. And you know what? This is the key. And I love walking through all three pieces of this. This is the key piece to reinforce the idea that if you do sell the high of a market, you've probably tried 15 times to do that and invested a fair amount of money. So it's a fool's errand. As much as we all want to try, it's not a productive strategy here. And you're right. And, Frankie, we talk about the benefits for futures, and I think an ES contract, and I might be a little low, is around $12,000 in margin. So you think, I've got a $50,000 account, that fits in. Well, if you think about it, what you're controlling, which is, as you said, $200,000, is that any part of you can swallow the buying power. Is that any part of a balanced portfolio, adding that in there? It's such a mismatch of everything else you have on within a portfolio. And that word speaks to diversification. Such a mismatch for these institutional futures. So you're absolutely right. You have to think a little bit about, yes, whether it's a huge future like that or the SM75, you get the same benefits of the capital efficiency. It's just, does a $6,000 product fit into my portfolio better? For a lot of us, absolutely.
And that's where that capital efficiency, Pete, gets its bad name, which is leverage. The word that everybody kind of like, oh, futures like leverage, it's risky. And that leverage exists and that added risk exists. But where it gets that bad name and that negative connotation is, when you have, perfect example, a 50 grand account, right, and you can fit in the buying power of that S&P 500 future, but that efficient margin, the efficient capital usage with futures means that you're likely to see that number in gains or losses in the next week or two. And so just because you can fit that product into your 50 grand account doesn't mean that you want to actually realize a 10 grand loss, right? And so that's why downsizing, first way to sell stocks there. The next step, a plan of attack for shorting the stock market, Pete, is further smallifying with options. And this is the same as most people when they get into options. First strategy, covered call. Buy stocks, sell call. What does that call do? Well, it gives me some space to the downside. I give up some of that upside risk. So say I bought a stock at 100, I sell the 105 call for $2. Right. And so now I'm theoretically long at 98, but my upside is capped at 105. I give up a little bit to get that long trade smaller. Same thing to the downside. I want to get my short trade smaller. So what do? I sell the futures contract, and then I can sell a $10 wide put spread in IWM, DIA, SPY. We'll have options in SM75 soon that you could just sell the put straight up against it. What will that do? Well, I'll get, depending on the market that you choose and depending on where you place those strikes, around $1 or $2 worth of credit. What does that mean? Well, if I sell SM75 at $68.50 and I sell the put spread against it for $1 or $2, now I'm short up at 69.5 or 70.5. I've given myself some breathing room. I've smallified the trade even further.
Absolutely. And we talk the term cost basis reduction.
Yep.
And you know what? That's what it is. It's my cost basis, or where I'm short, how I can make that short at a more attractive price point. And that's what this is I am not trying to throw the dart at the bullseye and the top, because we know that's not doable. What we're doing is giving ourselves a range to be right in if we have a bias. And that is such a powerful piece and you mentioned this, powerful piece to keep you in the trade, keep your idea alive.
Yeah. And then the last thing here, third way to sell stocks and to increase your time in your speculative trades even further potentially could be this pairs trading. Absolutely. Which I know, and these three different ways go from the simplest and the largest way to the most complex, but the smallest way that gets you into, like, if you sell an S&P 500 E-mini future there, Pete, and you picked the wrong day, the sell-off was on Friday, but I sold it on Tuesday, you're probably out of that trade by that sell-off just because of how large the market is here. This is one where it's like, I can put this on, and as long as I'm comfortable, look at this y-axis. This is in notional dollar amounts. As long as I'm comfortable with taking, $100, $200, $300 worth of losses, I could be wrong by a couple of days to even a couple of weeks. This is the last year plus of movement in the SM75 to sticks pairs trade here. And all of the movement, Pete, is just a little bit over $1,000 for a whole year, right, as opposed to $1,000, which some of these traditional futures contracts can move intraday. And so what you're looking at here is selling that SM75, which has skyrocketed here, any of the charts that you want to look at, and then buying a similar stock market in sticks that's underperforming it a little bit. And this, first way to get small when you're selling stocks is to go to a futures product that affords you greater flexibility. It's not as big as those traditional futures that you're probably first hit with when you enter the scene here in futures markets in general. Next, you can add some options to that short position, a short put or put spread that brings your break even higher, gets you short at higher prices, and extends duration. And the best way to extend duration is pairing one equity market against another.